Hello and welcome to the Weekend Investing Daily Byte of 27th of August. And today we are trying a new format. Here we are going to do the update segment in a different video, and the description is there in the description box below. So for today's market update, please go see that. Today in this discussion, we're going to talk about shocking data from 3-year study on stocks, mainly large cap stocks, the top 100 stocks. You would not have imagined this data. And this data is courtesy ET News. Uh, Nifty 100 is the underlying uh, universe. In the last 3 years, absolute gain on Nifty 100 is 45%. 3-year CAGR is 13.14%. And primarily the gains have come in the last 6 to 7 months, starting from maybe April of this year. And we are in the 8th month. So about 5 months is where uh, the gains have come from, and prior to that it was pretty much par for the course. Now this is Nifty 100. Now if we were to look inside this 100 index, what will we find is the main crux. So in the top 100 stocks of in Nifty 100, which is made up of the top 100 stocks, you are finding that top 40 stocks are underperformers. So out of 100 stocks, 40 stocks have underperformed. And of course, the names are very large, big names. So there is a 3-year CAGR, which is there in the first column. There is a 3-year CAGR relative to the Nifty 100 in the second column. And of course, some stock specific ROC and price to book, which is very healthy for a lot of stocks. So if you look at ROC and price to book and then buy it, and then again, you find that there is no performance. So there is always a gap or a delink or a lag between these two. So you can't just look at numbers and say, okay, now I'm buying this because these numbers are so good. So SBI Cards has done a 3-year CAGR returns of 11%, minus 11%, CAGR returns of negative 11. Adani Total Gas minus 8, Wipro minus 6, Berger minus 5, Adani Energy, Shree Cement, Divi's Lab, so on and so forth. So these have given actually negative CAGRs. But when you compare it to Nifty 100 index, they are much deeper. So 26.9% negative CAGR. Imagine if you are concentratedly had bet on 2 or 3 of these stocks, how far behind you are versus even the index, the Nifty 100. Asian Paints, for instance, minus 14.9% CAGR. Bajaj Finance minus 16% CAGR. Berger Paints minus 21%. Dabur India, FMCG favorite, minus 14% CAGR. Then you have even bigger names. HDFC Bank minus 13.6% CAGR last 3 years relative to Nifty 100. On an absolute basis, it is up 2%. Great, fantastic. Infosys minus 13.5%. Tech Mahindra minus 11.9%. Tata Steel minus 11.5%. Levers minus 13.5%. Kotak Mahindra Bank minus 13.8%. More big names. Tata's Consultancy Services minus 9%. Nestle minus 8%. DMart minus 5.7%. Pidilite minus 4%. Reliance minus 4%. You have IndusInd Bank minus 3.8% CAGR. You have Britannia minus 1.3% CAGR. Apollo Hospitals minus 2.73%. These are fantastic companies. I'm not saying these companies have anything wrong in them. And they are 40 in number, which have not beaten Nifty 100. Nifty 100 is the underlying theme, underlying index, and which itself has not done anything great. 3-year CAGR in a supposedly a strong bull market like we have right now is nothing. 13.14% is actually just maybe a 1% above the long-term average. So to have gotten to 3-year CAGR at 13.14 is nothing, I would say. And even in that nothing, 40% of the stocks have not been able to beat this also. And there are severe cuts on the downside. So 20% CAGR over 3 years is a lot of fallback from the index itself. Anyhow, so many of these large names which are very popular, which people blindly invest into, saying that, nothing can happen wrong in HDFC Bank, Asian Paints. Sooner or later they will catch up. Nestle, Marico. Yes, sooner or later they will catch up. But the few things that you need to see is that sooner or later could be 10 years. It has happened in Reliance. It has happened in Hindustan Lever. It has happened in ITC. Are you willing to wait 7, 8, 9 years for that next 5 years to be great? What if after waiting for 9 years, the next 5 years is not great? You've lost 15 years of your life. Please see the opportunity cost of waiting. What if there is a disruption in the market? The big names that you see today have some loss of market share. What if some new technology comes and disrupts that space? What if the management leaves the uh, the entity and goes somewhere else? What if consumer preferences change over a decade? Anything can happen. Anything can happen. To just assume that because this was a big name, because it has performed in the past, hence I'm willing to wait 10 years on this, is in my view extremely, extremely dangerous. So what is the way forward? What is the path forward? Look at the best performers. Look at the best performers of Nifty on the last 3-year CAGR returns. Adani Power relative to Nifty 100, 93% more than Nifty 100 CAGR. HAL 89%, IRF 4%, Trent 83%, Varun Beverages 62%, RE 1%, TVS Motors 60%, Bharat Electronics 57% CAGR, more than Nifty 100, I'm saying. Absolute CAGR is much, much more, 73% for PFC, 66%. And those who are into momentum investing, and I'm not saying necessarily weekend investing, any other momentum investing strategy also would have seen these stocks in their portfolios in the last many years. And that is why those strategies have been able to do well, because they are sitting in the strength of the market. So 100 stocks of Nifty 100, 40 are losing badly, 20 are doing well, and the rest 40 are just about here or there. So you want to be in the top 20, 30, 40 stocks of the index at all times, and that will keep changing. So you need to change with it. See, the only, as they say, the only, constant that is there in the world is change. If you will not change, uh, with times, I mean, you will get demolished basically. So 40% of Nifty 100 has underperformed the index across 3 years. 3 years back, 2 years back, PFC, IRFC, HAL, REC, Bajaj Auto, all these stocks, nobody would have guessed that they will do well in the next 3 years. And as stocks start to go up, for instance, Zomato is rising or some other rail stock is rising, people are very, very cautious about stocks that go up. So that is the reverse psychology that happens in the market. Stocks that go up, people are afraid of them. Stocks that come down, people are very confident that yes, one day I will make a, you know, superb return on this. The psychology is actually reverse of what it should be. Stock is going up, be happy, be invested in that stock, and don't be afraid of stocks that are going up. So Nifty 100, and this is, I'm not even talking about the weights here right now. So if you see the Nifty 100 weights, several of these counters that have not done well are very, very heavy weighted. HDFC Bank, for instance, Infosys, Reliance, Hindustan Lever, Asian Paint, these are heavy weights in Nifty 100. So actually speaking, if you were not to be invested in these heavy weights, not only are you avoiding that underperformance, but you are avoiding that underperformance with that heavy weight. So it's a double whammy actually, if you ask me. So when you're doing index investing, you invested in a Nifty 100 ETF or something like that. Actually, you are getting to invest into you know stocks that are heavyweights, and likely that they are not performing right now. So the only performance will come from low weight stocks as they start to become heavyweights over years, and that when combined with the performance of heavyweights, your overall returns become zero, and hence you see uh, Nifty 100 also not doing so well, at even though it had performers and underperformers, it did only 13% CAGR. So What the question to be asked is, can you create a rule-based framework and avoid the weak stocks and also avoid heavyweight allocation to them, and only ride the winners? Wouldn't that be really amazing? Almost like, a heavenly kind of a thought. So few momentum portfolios from the market. Nifty 100 has done 13%. Momentum portfolio 1 on Nifty 50 has done 23%. Momentum portfolio number 2 on Nifty Junior has done 35% CAGR. This is the kind of rule-based momentum system can fetch from these benchmarks by just focusing on the strength in the market, by just focusing on certain uh, the winning and the stronger stocks, and not allowing any heavyweight to be given to them, to the weaker stocks. So even if you do equal weight, but then only allocate to stocks that are doing well, you get this kind of differentiation from the same universe. I mean, it is amazing that one portfolio can give you 23 to 30, 35% return, whereas the most favorite stocks are giving you a negative 25% return, or negative 20 or negative 15. That is the kind of difference, and few years of this difference, and you can see that portfolio of person A versus portfolio person B can go like this. If they were equal before 3 years, after 3 years they'll be like this. That is the main difference that can happen over slight selection strategy framework if you have, and not blindly just do index investing. So let us know how much exposure you have to Nifty 100, how it has done versus your other portfolios. What do you think about index investing? And does this concept that if you invest in a rule-based, systematic, framework-driven selection of strength, can it give you that additional alpha? Let me know your answer. Thanks. Bye.